Hello everyone and welcome back. This is Aaron Yoon coming at you from New York City, and today we are going to discuss how to profit through stock market crashes like the one we had in 2020 during the COVID pandemic, and how to profit through stock market crashes automatically without having to learn to trade, hiring a fund manager, a financial planner, or a retirement planner, or etc., or having to watch the market and pay attention and look at charts all day long. So let's get right into it. Have you been through one or more of these? Subscribing to stock picks newsletters like Motley Fool or any of the other dozens or hundreds of newsletters out there that spoon feed you trades, or signing up for trading classes, or maybe even derivative classes like Forex or options classes. Those are all super popular these days. And have you felt frustrated that nothing was working? That the learning curve was too high? That it feels way too difficult? Maybe it's just not for you. And so maybe you just throw your hands up in the air and you give up and you say, you know what, I'm just going to put all my money in an index fund or a mutual fund because the stock market always eventually goes up. And you just wait and you hope it'll all work out. If you've done one or more of these, then you need to pay attention to the end of this video, because by the end of this video, you're going to realize that none of this is your fault. The industry and the government and all the banks, they want you to feel frustrated. They want you to feel confused and overwhelmed, so you continue to rely on them to help you. That's how they make their money. They want you to feel like you need them. But that's not the case. And by the end of this video, you'll find out why. So here's one thing that nobody has told you about the stock market. I'm willing to bet that no one has told you this one thing about the stock market. And the way it's a sports analogy. So imagine being one of these guys. Okay, so you're playing basketball at the playground. You're not particularly good, as you can see. You're not even hitting the rim. But all the funny jokes about poor basketball playing aside, I want you to notice something about these two pictures. All of these players are playing in a recreational, have fun, relaxed, and relatively safe environment. That's why they feel comfortable, even at their skill level, going outside and just having fun. But imagine if the only place where hoops and basketballs were available to you was if you were going to play against these guys. Some of history's best basketball players ever, in front of tens of thousands of fans watching, yelling, screaming at you as you're playing. We have Michael Jordan, LeBron James, Steph Curry, some of the best players ever. Imagine if your only option to ever play basketball was against these players in these stadiums, in front of these people, in front of all these fans. Well, that's kind of exactly how stock investing is like. That's pretty much exactly how the financial markets work. You're only allowed to ever compete with the cream of the... You're only ever allowed to compete with the best of the best, with Wall Street's finest, the creme de la creme, if you will. Your only choice is to compete against the street itself. Not very fair, is it? So just think about if you were one of these guys playing against, Michael Jordan, the greatest player ever, greatest basketball player ever, and you're one of these guys, you're way too small, you're definitely not skilled enough, you don't have the conditioning, you just don't have any of the appropriate tools or the coaching or the trainers or any of the support necessary for you to be able to compete on this level. And that's probably how your experience has been in the stock market world as well. That is until now. Because now you can level the playing field and go toe-to-toe with Wall Street. Here's what you're going to get in this video. If you're a beginner, whether you're a trader, investor, doesn't matter. You're going to learn to earn while you learn for free. So I don't want to take anything away from anyone who wants to learn how to trade. But while you're learning, you can be profitable, right? You don't have to go through the growing pains that most traders go through for years if you use the simple tools that I'm about to show you in this video. You're also going to get, let's say you're not if you're not an investor or trader at all, you're just thinking about it, then you will also get a set and forget investment tool so that you never have to worry about investing or trading ever again. Your choice. If you're an intermediate level investor or trader, I'm going to throw a little bit of lingo at you because you should be able to understand what I mean. So if you're an intermediate level trader or investor, you're going to get automated risk management, which you should know is pretty much the name of the game. That's risk management is everything. You're also going to get an automated diversification of uncorrelated strategies, which is basically the same thing as hedging. So if you're an intermediate level trader, you should know what these words mean. If you're a beginner, don't worry about it. That wasn't directed at you. But if you're a professional trader, what you're going to get by the end of this video is basically your time back. You don't have to be watching the markets at all times. It can be automated for you. So I'm going to show you how the lies about the stock market that you probably believe, how to achieve your retirement financial goals faster. The average person in America, anyway, isn't retiring. The average person in America, anyway, isn't reaching their financial goals at all by age 65. Usually, what happens is our senior citizens have to work well into their 70s because they just don't have enough money. We can reverse all of that, and I'm going to show you how. I'm also going to show you how to automate so you don't have to learn anything. There's no learning curve here. I'm not going to teach you a class or a crazy trading strategy. I'm going to show you how you can do this fully on autopilot. But in order to be able to understand that, you need to know the difference between the truth and what's fake news out there. So we will talk about that as well. So let's just compare this. As you can probably surmise, with all the talk about me, with all the talk that I've been doing about automation, you're probably thinking there's some kind of AI at play, and you'd be correct. Absolutely. I'm talking about using algorithmic intelligence to automatically time the market. And so here's a sample of results from myself and my clients. Our portfolio, not all my clients have exactly the same portfolio. They're diversified in an assortment of different stocks, but pretty much everybody has most of their portfolio and their money. Most of my clients have their money. Let me say that in a different way. Most of my clients have most of their money in the S&P. So this is the fairest comparison. The S&P 500, which is what most people use as the score to beat, the measuring stick of the health of the US economy and ultimately their investments, is a crummy little 3.36% as of the recording of this video. We've just barely started to recover from the COVID crash, as you can see here. This downturn is the COVID crash that we experienced in February, March, and just slowly grinding our way up, and finally turning a profit within the last month or so. Whereas with our AI, we've been profitable. If you just look at the picture of this line, it doesn't look like there was any crash. How can that be when we're trading the same index, the same S&P 500? Well, you're about to find out why. So, how did I figure all this out? You know, as of 5 or 6 years ago, I did not think I would ever get into finance. I am not a guru whatsoever. I never thought I would get into this business. In fact, I am a child of South Korean immigrants. I come from a family of immigrants. And unlike most immigrants, though, my family came here already being millionaires from the wealth that they accumulated in South Korea. So this here is a picture of me when I was a kid. And this actually is not my mom. A lot of people think that, you know, this is my mom. But it's actually my grandma. And this is when she was, you know, at her peak. This is when they just came to America. I was born here, like a few years after I was born. And this is at the peak of their wealth. My grandparents owning their business in Queens, New York. My grandma was known as kind of the queen of Main Street when it was mostly a Koreatown back in the 80s. So I think this picture was around 1988 or 1989 when they were at the height of their affluence. But I don't say all this to brag, actually, because I say all this to actually make a point. Because in 2008, if you fast forward to 2008, the global financial crisis just changed everything. I learned that my grandparents were going to retire with basically no savings, which was very surprising to me because I thought once you became a millionaire, then it was easy to stay a millionaire, but that wasn't the case for my grandparents for some reason. 2008 was also the year I graduated college, and it was also the year that nobody was hiring entry-level college graduates. So this whole notion of go to a good school and get a good job, and that's how you live a happy life, all that entire formula was proving very dubious to me. I lost faith in the entire system. And I kept asking myself, what was the point of becoming a millionaire if you can't maintain it? If you can't stay a millionaire, what was the point? So I decided I really needed to get this, the personal finance aspect of my life handled. But it wasn't until I actually got hired at a hedge fund that I got to get a sneak peek behind the curtain and see how the billionaires operate. So this is what I learned. This is how billionaires invest. Billionaires don't lose money in stock market crashes. They also underperform the S&P 500 because average ROI does not matter. And we'll get into why it does not matter. I'm going to show you mathematical proof of why average ROI does not matter in just a few moments. They also time the market. Most people think this is impossible, but for billionaire hedge funds, equipped with the right knowledge and the right tools, it is not impossible at all. It's actually quite easy. They also keep a healthy portion of their funds in cash. They don't go all in all the time. So if you look at just these couple, this is just the tip of the iceberg of how billionaires invest, but this is just what's relevant for the scope of our conversation today. This is almost completely the opposite of how regular folks like you and me have been taught to invest. Most people go all in all the time and never sell, thinking that that timing the market is impossible. So they just put all of their money in a 401k, for example, and they just leave it. They'll lose money during crashes because they fully believe that one day it'll come back. This is highly, highly inefficient, and no billionaire that is worth his or her salt is ever going to invest this way. So here's the billion-dollar question. Would you sacrifice 25% of all of your profitable years if you could go back and reduce all of your losing years by 75%? If you can answer this question, then you've pretty much solved the puzzle of how to profit during stock market crashes. This is the billion-dollar question. And in order to answer this, I really need to do a lot more than a couple of PowerPoint slides. I really need to switch over to a more dynamic platform and show you some spreadsheets. So in order to show you the mathematical proof of the answer to this question, I'm going to switch over to Excel. And I know some people think of Excel as as something very, very... Hold on a second. In order to answer this question, I do need to switch over to Excel. There we go. And I know a lot of people think of Excel as a really scary mathematical technical tool, but I promise I'm going to make it super simple and walk you through it step by step so even a fifth grader can understand this. What you're looking at here is a sample size of all the performance data from the S&P going back to 1995. I'd say 26 years is a healthy sample size to do a technical analysis, wouldn't you? So what you're looking at here is the performance of the S&P 500 index, which we already discussed is the score to beat. It's what most people use as the measuring stick. And we have the beginning price of the year and the end price of the year since 1995 to 2020, all the way up until September 10th, which is today as of the recording of this video. And what I've gone ahead and done here is I'm showing here in this yellow column the ROI, the percent increase or decrease, depending on whether it was a winning year or a losing year, based on the beginning price of the year and the ending price of the year. So this is 34% for 1995, 20% for 1996, so on and so forth. You can see some red numbers. The losing years are in red. So the from 2000 to 2002, we had the dot-com crash. If you some of you may be old enough to remember living through that. More recently, in 2008, we had the global financial crisis, where the S&P dropped. It performed at negative 38.49% in 2008. 2018, we had a mini crash at the end of the year, and the S&P finished at negative 6%. And in 2020, you see, we are looking at gains. It is a green number, but we did suffer through the COVID pandemic, which crashed the market in late February and on into mid-March. So I just summarized all of the negative bear market years or times of turmoil when the stock market was negative. And all, as you can see, if it's zero or negative, the ROI is listed in red. And as you can see, most of the time, the S&P is gaining. But here's the question. Let's eliminate the data and just look at a very, very simple overview looking only at the ROI. If I take these 26 numbers over the past 26 years and I average out those 26 numbers, I get the magical 9.5%. This is where your retirement planners or your financial advisors get their average return on investment figure from. 9.5% over the past 26 years. It is 100% if you can tell with the Excel formula. If you want to be critical of my data here, you can tell that it is, you can tell that it is absolutely correct. So it is absolutely factual to say the S&P will give you 9.5% per year on average. However, the way that information is conveyed, and for 99% of people, the way that it is interpreted is like this. They'll have you think if you start off with $100,000 of starting capital in 1995, that you'll have a steady 9.5% increase per year. That your estimate will just steadily increase all the way up until 2020, where you'll be sitting pretty with $1 million. This is what most people believe to be true. Now you can probably tell because I put in big fat red letters here in capital letters that I wrote that it's false. This is completely not the case. Let me show you why. If we actually take $100,000 and apply the real, actual percentage performance year by year, not just averaging it out and increasing it steadily by 9.5%, but actually applying these numbers year over year, then we get something like this. You'll see that the first year is the easiest to measure, which is 34% more than 100,000 is 134,000. So on and so forth. You can see during the negative years that the balance actually goes down, as you would expect. You can see in 2008 you have a drastic, almost 40% loss, but between 319,000 all the way down to 196,000. And if you look all the way to the end of the chart here at 2020, you're sitting on 727,000, not $1 million. Your estimations were wrong by approximately 30%. You underperformed by over $300,000. This is why most people are not retiring with enough money. If you're one of the lucky people that actually have a 401k or saved early enough to have an IRA, because a lot of people don't even have any savings at all in this day and age. But if you're one of the people that do, then you're expecting your gains to look something like this, but you're actually getting this, and you're wondering what happened to all my money. And by the way, all of this is before you start paying fees. Because if you have a financial planner or a retirement planner or a fund manager, 401k, what have you, you are absolutely paying fees that you probably are not paying attention to because it's virtually invisible. So this number would actually be a lot lower. If you're investing yourself, then this might be a little bit, and you put all your money in the S&P, being a solo investor, this figure might be a little bit closer to what you might have experienced in the past 25 years. But once again, you've underperformed you've underperformed your estimations and your projection by over $300,000. You were wrong by over 30%. So what if we make a modification here? Going back to the $1 billion question, what if you actually did sacrifice what if you actually sacrificed 75% of all of the green numbers here? I said that wrong, excuse me. What if you went back in time and you could sacrifice 25% of all of your gains, all of your green numbers, in order to reduce all of your red numbers by 75%. Remember, that was the $1 billion question. Let's take a look at what happens if we do that. So I'm adding another column here called the 75-25 adjusted ROI, where if the number is green, then we reduce it by 25%. If the number is red, we reduce it by 75%, so we lose less. So in other words, this is a good example. In the year 2000, instead of losing 10%, you only lose 2.5%. In the year 2008, instead of losing 38%, you lose only 9%. However, in years like 2009, instead of gaining 23%, you only gain 17%. So on and so forth. 2019, instead of gaining 28, you only gain 21. And you can see here at the end of the year, or at the end of the 26-year period, you are actually underperforming the S&P. Your average ROI would be 8.89% as opposed to the S&P's 9.5%. But look at if we apply this to the starting capital of $100,000. What happens then? If you fast forward from 1995 all the way to 2020, you're actually sitting on $823,000 instead of what the S&P would have given you had you bought and hold the entire 26-year period, which is $727,000. You actually made almost $100,000 more, even though you averaged almost a full percentage point less. This is what billionaires understand, and this is why they don't care about beating the S&P. This is why they don't care about average ROI as a metric of performance. They care about the number of dollars that they've put into their pocket at the end of every year. This is possible because this is only possible because of the concept of risk management. The losses are losing is way stronger than winning. That's the takeaway from this chart. The reason this is a false belief is that it assumes no losses. It assumes steady 9% increase no matter what happens. This is not how the stock market works at all. This might be how a mortgage works or a loan works from a bank's perspective, but this is absolutely not how the stock market works at all. So you cannot use this formula and expect to get accurate numbers. But it is the formula that most of your financial advisors are using, which is why I call this this is a mistruth or a misconception. If we actually take let's take this one step further. If we, instead of doing a 75-25 adjustment, we actually extend it to 85-15. In other words, I will sacrifice 15%, only 15% of my gains in order to reduce 85% of my losses. Then what we have is an average ROI that does outperform the S&P at 10.5%, and it even exceeds all of your false belief expectations as well. Actually, let me check this. Let me check if this is going to. Nope. So what we have here is if we adjust the ROI to an 85-15, then we grossly outperform both in dollars and in terms of ROI percentages. This figure is more of a meaningless figure. I think you can see that by now. What really matters is the number of dollars in your pocket at the end of the day. And here what you'll see is that we have outperformed the market significantly. The AI that we're using, that I'm talking about, is actually, this is very conservative even for the AI. The AI that I've been using for myself and my clients is actually closer to averaging like something a same kind of formula here with the adjusted risk, but it does end up averaging out. If we actually apply this formula to it, it does end up being something closer to 12 or 13%. So you'd be looking at something way higher than this. So let's go back and check out what makes this possible. How does this math actually work? And I think a visualization is easier than a table full of figures and numbers. So let's take a look. So what we have here is a chart of the 75-25 adjusted ROI, which is in orange, versus the S&P 500 straight up, buying and holding forever the entire time, in blue. So what you can see is we are underperforming the S&P for a while. That is until the global financial crisis crash. We don't dip nearly as much, and from then on, we just match the pace of the market, and we're always ahead of it. And so every crash there is, the separation will become greater and greater. It was underperforming until the first crash that we see on the chart here, which is the 2000 .com crash, or .bomb crash, I should say. That's when the score became more or less even. And you can see for about 5 years, we're just matching the S&P pound for pound, right? Dollar for dollar. And in the next financial crisis, we see that the S&P drops. This is your 38% drop right here. But the AI does not drop nearly as much. And then from 2009 onward, it is just matching it. Now, it might be hard for you to tell here because we're still smack in the middle of 2020 as of the recording of this video, but the blue line did significantly dip down, and there is an increased bit of separation between the orange and the blue. So going forward, we can expect to see more of a separation as the orange continues to grow faster than the blue. So what does all this mean about average ROI, or average return on investment? It is actually a mistruth. A mistruth is factually correct information that leads to a false belief or misconception. So the whole 9.5% is 100% factually correct, mathematically correct and accurate. However, it leads you to believe that you will not lose. You will steadily So the 9.5% is completely mathematically accurate, but it leads you to believe something that's completely false because it assumes that you won't ever lose. That estimation makes a huge difference. As we saw, losing is much, much stronger than winning. So average ROI only works when you only have green numbers, when you only have gains. For example, things like a loan, or things like, car payments or a mortgage, things that where even if you miss a payment, it's not like the bank or the financial institution loses money. They just get money slower. You're just making payments. If anything, they're making even more money because the interest still compounds. They might be charging you late fees. So for them, it's green. And when they give you this kind of language of average ROI, what they're giving you is green language for something that is, what they're actually giving you is applicable to green money language. This is something that I go through in my training course, this secret language of billionaires, where you have to understand the difference between the green money language and red money language. Average ROI is only applicable in the green money language because it assumes only green returns. The stock market shows red or negative years regularly, as we saw. Even though it's mostly green, you do have crashes. In the past 20 years or so, we've had 3 crashes. And we've had more than 3 negative years of the S&P. So you have to... So when it comes to the stock market that could potentially show red numbers, then you need to speak the red money language. The biggest problem in the industry right now is that your financial advisors and your so-called fiduciaries are giving you green money estimations for something that should be measured in red money language. This is kind of like if you were to confuse scoring tennis with the way that you score football. In football, a touchdown is 6 points with a 1 or 2 point conversion. Most of the time you go for the 1 point conversion. Whereas in tennis, the first point you score is measured with 15. Imagine you confuse the two and you reported the incorrect score. You reported a tennis score for a football game and vice versa. That would be completely misleading information. No one would forgive you for that. But in this world, because most people don't know the difference between green money language and red money language, they assume that green money language estimations are always true, and then years later, when it's time to retire, they're surprised and they still don't quite understand what green money language is or what red money language is. There is a bonus here. There is a third money language as well, called blue money. This is not applicable for our conversation today because we're talking about investing for retirement. And so blue money is something that you would have to, you would find out if you... Blue money is not going to be discussed today, but you can find out all about it. It is by far the biggest, most popular money language there is. So you can find out all about it when you sign up for my money language course. So the red money is red. Just think of red as is for rapid. R for rapid. Red money is the fastest form of money, up or down, positive or negative. Remember the quote that timing is everything. It's not impossible, it's actually completely necessary to make sure that you get the maximum benefit of red money. And it doesn't matter if you're a day trader or a long-term value investor like Warren Buffett, timing is everything. You want to get in early, you want to get the good low price, and you want to buy at the good low price, and you want to sell at the high price. And losing is much stronger than winning, and risk management is everything. Basically, when I say timing is everything, I really mean that managing the risk is everything, which incorporates a little bit more than just timing. So all this being said, what is next? The next step for you is to check out the free AI app. You might be thinking to yourself right now that this sounds really cool, but I don't know if it's the right fit for me because I don't have enough money for it, or is it going to be hard to use? Is there a learning curve to use this? And it is absolutely one of the easiest things that you can ever do. I'll include a link to the video, to a setup video below, where you can just click to download the app, and you can get started for up to $6,000 of investment for free. If you want to actually invest bigger money because you've been saving and investing for a while and you have a bigger 5-figure sum or even a 6-figure sum that you want to grow more rapidly, then there is a fee for larger money because you get more sophisticated kinds of portfolios. So you can click the link there. I'll include another link below for you to schedule an appointment with somebody, to either with myself or someone from my team, to actually get on the phone or on a Zoom and go through a demo of how this might work for you for free. The consultation is completely free, and you can decide whether this is a good fit for you. I don't see why it wouldn't be if you want to automate market timing the way that hedge funds do. But ultimately, it's your money and the choice is yours. So make sure you click the link below and schedule a call, or check out the free app if you want to take it out for a test drive with under $6,000. That's it for today. Thank you for watching, and everybody have a great night, and stay tuned for the next video.